In this video, I'm going to discuss the accounting for intangible assets. And in doing so, I want to repeat a pattern that perhaps you've seen before in the other videos. What we do with intangible assets is amortize them over the future periods that benefit from the use of the intangible asset. So you've seen this pattern of allocating cost of long-lived assets to expense in a systematic and rational manner to periods that benefit from the use of that asset in the past. You've seen it for depreciation, for property, plant, equipment depreciation, and you've seen it for depletion of natural resources. In the case of intangible assets, usually we will amortize the cost of those intangible assets using the straight line method. But the idea is the same. We have costs that benefit future periods, and we need a systematic and rational manner of getting that to expense. So what are intangible assets? It's an asset that will benefit a future period, but lacks physical substance like you would have under property, plant, and equipment and natural resources. So what are some examples? You have patents, you have copyrights, franchises, licenses to sell something, trademarks, trade names, goodwill, purchase goodwill, customer lists that you acquire. And all of these have future benefit for us, or may have future benefit for us, but they lack physical substance. It's not like an actual machine that you're buying. So we still have to do the accounting for it. And here's what we are allowed to capitalize, okay? So the interesting thing with intangible assets is that in general, you must purchase them. You cannot create your own intangible assets and capitalize them, to certain limitations, and I'll explain a little bit. But in general, when you have intangibles to amortize, it's because you've purchased those intangibles. So you might have purchased a patent or a copyright, the franchising fees you paid and you acquired, etc. Usually these things you are not generating on your own, or if you are, the amount that you're allowed to capitalize for internally generated ones usually is small, and hence many times they're just expense. So if you purchase one of these intangibles, obviously you can capitalize the cost of that purchased intangible. And then also, if you have to defend the patent or the intangible, whichever intangible it is in a court, any legal fees in defending that intangible, any unrecovered legal fees can also be capitalized and included as part of the basis of that intangible. Now here's where you got to be careful, and this is why many times when you generate your own internal intangibles, you don't capitalize. The current GAAP does not allow you to capitalize any research and development costs. So even if you're creating your own patent internally, all those costs that you incur in the research and development phase, those are just expense. They're not capitalized. Now, once you have something that you actually will legally request protection for whatever that intangible may be. So once you begin the process to secure that intangible, that's when those costs begin to be capitalized, not before. So everything before is R&D. And then once you reach a point where you say, okay, we have something here, let's file for a patent, let's say. It's from that point on that you start capitalizing. But when you think about it, a lot of times these R&D costs are the ones that are the big amounts, right? You've incurred a ton of money trying to develop a patent. All that has been expensed. And then once you get to a point where you're going to actually file for the legal protection under that patent, those costs may be small amounts, and sometimes companies just expense them. So that's why we say that intangibles, for you to actually capitalize, most of the time they're purchased intangibles. All right, so let's say you have an amount in an intangible asset that needs to be accounted for. And The amortization of it is basically broken down between whether that intangible asset has a finite life or a limited life or an indefinite life. So if it has a finite life, a limited life, then we know the period in which we will probably use it for. So the amortization of it will be the shorter of its legal or useful life. So certain intangibles have a legal limitation. For example, if you have a patent, you're protected for 20 years with that patent. So you would look at the 20-year versus what you will use it. And if your expected useful life is less, then you will amortize it over that lesser amount, or the 20-year period for that patent, let's say. And as I stated before, usually we just use the straight line amortization for amortizing limited life intangibles. So just for illustration, the journal entry would be an expense to amortization expense, and then you would have some accumulated amortization account here, or you could just directly credit the actual intangible. So that's if the asset has a limited life, but not all intangibles have a limited or finite life. Some of them you just can't determine, right? So an example of that would be goodwill. Goodwill arises when you buy another company and you pay more than what the net assets of that company are worth. So that amount in excess is referred to as goodwill. Well, you really, in general, don't know how long you're going to benefit from that goodwill. So what ends up happening is that if the intangible asset is determined to have an indefinite life, you cannot amortize it. Okay, so it just stays in the books at that amount. But it doesn't mean that you're not testing these assets for impairments, right? So all of our assets on our books, we're always making sure that they're not overstated. And that process in terms of intangibles is referred to as impairment tests. So look at what we have here. We have limited life assets that are being amortized. And even though they're being amortized, we're still testing them for impairments. And we'll talk about that in a minute here. And then we have indefinite life intangibles that are not amortized, but they are tested for impairment. So one way or another, we're making sure that these intangible assets are not overstated. So let's look at the rules here for impairment testing. If it's a limited life intangible, like in here, then it's being amortized over the useful life or the legal life. And the impairment rules here are going to be the same as for property, plant, and equipment. So if you refer to the property, plant, and equipment video, this is exactly what we have over there. It's a two-step process. You first perform a recoverability test. So you look at the book value of that intangible and compare it to the undiscounted expected future net cash flows from that intangible. And if the book value is greater than what you expect to recover, or you can look at it a different way. Sometimes it's easier to verbalize these things the opposite. If what I expect to what I expect to recover from this asset is less than what I have on the books, then we would say that the asset fails the recoverability test. You have an impairment and you go to step 2. This is exactly the same as the impairment test for property, plant, and equipment. So then your loss would be the book value minus the fair market value or the discounted expected future net cash flows. All right, so just real quick, in blue I have here where this is the undiscounted cash flows. That's for the recoverability test. But then when you actually do the loss calculation, it's the discounted amount or the fair market value. All right, so that's the impairment test under the limited life intangible assets. Exactly the same as property, plant, and equipment. If you do have a loss, then your loss is a debit here, and then you would just credit the intangible asset at that point. Now, for indefinite life intangibles, the impairment test is simpler. It's just a straight out fair market value test. So you don't deal with this undiscounted expected future net cash flows. No, you don't. So for indefinite life, you go in here and you just perform a fair market value test. The idea is if what it's worth is less than what's on the books, then you have an impairment, and the loss is straightforward, just book value minus the worth. Similarly to this loss calculation here. Okay, and the reason we do a fair market value test here is because if you think about it, if you have an indefinite life asset, the expected future cash flows from that asset can stretch out over many, many years. So to do a recoverability test would probably end up passing, not failing the recoverability test, just simply because of the extended period of time from an indefinite life. So because of that, we just go straight forward and say, look, this is a comparison of what's on the books versus what it's worth. And that's the fair market value test. So the way we would say this is, just for correct verbiage here, if you have limited life intangibles, you perform a recoverability test to determine if there's an impairment. And then if you have an indefinite life intangible, you perform a fair market value test to determine if you have an impairment. Okay? Now, the last thing I'll mention here is, even though usually goodwill falls under this indefinite life category where you don't amortize, and we just explained what the impairment rules are for indefinite life assets, goodwill in particular is a little bit different, okay, in the way you test it for impairment. This will be the last intangible that you test for impairment, and this is the last test you'll do after you've done all your impairment tests for all intangibles, after you've done all your impairment tests even for property, plant, equipment, and all other assets. Okay, so once you've done all that, this will be the last test that you do for any goodwill that you've acquired. So remember, you cannot create your own intangibles, and specifically, you can. Let me restate that. In general, okay, you don't create your own intangibles because a lot of those costs are R&D and they're expensed, right? So you only get to capitalize once a legal process to secure that intangible begins. So I said earlier that many times that's a small amount, and many companies will just simply expense it. Goodwill in particular is one that 100% you cannot create your own self and capitalize. So what is goodwill? Goodwill is that recognition of your company that people value just simply because of the name. So you might actually have created internal goodwill if you have a company that is highly valued, but if it's internally generated, you cannot come up with a value and actually capitalize what you think is your internal goodwill. There has to be a transaction realized. In other words, you buy a business, and if a transaction is realized where you pay more than the fair market value of the assets, the net assets, then at that point you've acquired goodwill. So be very careful with goodwill. Goodwill is an interesting intangible. So just for the sake of conversation here, let's say that a company has total assets of, just so you see what I'm talking about, total assets of $200. This is their worth, not the book value. They have total liabilities of $150. So the worth, the fair market value of net assets here would be $50. If I purchase this company and I pay more than $50, then I have acquired a company for $50, but then I've also acquired goodwill in excess of $50. So the way you would record that is you would bring in the assets, excuse me, you would bring in those assets for $200, and this is just to give you a little illustration here. You would also have to bring in the liabilities because you acquire those liabilities. And let's just say I pay $70 for this company. If I pay $70 for this company, then I will have purchased this company and paid $20 for goodwill. So that's how goodwill gets in our books normally. You have to pay excess of what something is worth, a company is worth. So Here, we would test this goodwill for impairment every year, every period, technically. We won't amortize it, like I said over here, but it still has to pass the test of impairment. So that test of impairment is done a little bit different than these first two, because the comparison of book value versus fair market value is done at the whole business unit level. So, in other words, at the end of a period, I'll look at what the book value of the whole business, including goodwill. In other words, all the assets minus the liabilities at the carrying value on the books, and I'll see if the fair market value of that business is less. And if it is, then we have an impairment of goodwill. Okay, so for us to determine whether this is impaired, we look at it as a whole business, from the whole business perspective. And then if I do determine that it is impaired, then the calculation is you take the book value of goodwill, okay, and oops, there's no need for this here. You take the book value of the actual goodwill and you subtract the fair market value of the goodwill. All right, and that's how you determine your loss. And always, it's just a straight journal entry. This is not a big issue. The determinations of what something is worth, like for example, what the business is worth, that could be a little bit more challenging, because that could be based on what maybe the stock is trading at, or what you think the business is worth based on some present value calculation. Many different ways. So this is where it's a little bit more difficult. All these determinations of what something is worth right here, very subjective. So that's where the judgment comes into play. All right, this concludes the video on accounting for intangible assets.